Right now, the entire financial system is sending a very quiet, but very dangerous signal. On the surface, everything looks normal. News headlines keep changing. One day, it's geopolitical tension. The next day, it's something else. Markets react, people panic, then suddenly everything feels okay again. And just when investors start to feel comfortable, that's when the real risk begins. Because historically, the biggest market crashes don't start with fear. They start with false relief. This is the phase where bad news disappears, confidence slowly returns, and people believe the worst is over. Stocks start to stabilize, maybe even bounce a little, and investors rush back in thinking it's safe again. But in reality, this is often the final stage before a major breakdown. Welcome to Gold Silver Scope, where we simplify complex gold and silver market movements so you can clearly understand what's really happening behind the scenes. Now here's why this matters so much. The stock market right now is not in a healthy uptrend. It is in what we call a topping process. This is a slow, confusing phase where prices move up and down, creating false hope, while the underlying strength of the market quietly weakens. We've seen this before many times in history. In the early 2000s, markets didn't crash immediately after reaching their peak. Instead, they spent months moving sideways, creating the illusion that the bull market was still alive. The same thing happened before the 2008 financial crisis. Markets moved unpredictably for nearly a year before finally breaking down. And today, we are seeing a very similar pattern. Sharp moves, quick recoveries, sudden news-driven reactions. All of this creates confusion. But underneath that noise, something important is happening. The structure of the market is slowly breaking down. Now here's where gold and silver come into the picture. Most people believe that when the stock market falls, gold will also fall. But history shows the opposite is often true. Yes, there are rare moments when both fall together, but those are exceptions, not the rule. In reality, when the stock market begins a true decline, money starts looking for safety. And over again, that money flows into gold and silver. Gold is not just another asset, it is a monetary asset. It represents stability when confidence in the financial system starts to weaken. And right now, something very important has already happened. Gold recently went through a correction, a sharp one. Many investors got nervous. Some even thought the trend was over. But if you look deeper, nothing important has been broken. The long-term structure is still intact. And at the same time, the stock market is showing increasing signs of weakness. This combination is extremely powerful, because when stocks enter a real bear phase and gold is already in an uptrend, that's when the biggest moves in precious metals begin. But to truly understand how big this move could be, and why it hasn't even fully started yet, we need to go deeper into what's happening behind the scenes, especially with central banks, money flow, and investor behavior. To understand what's coming next, you need to understand how markets behave during major turning points. Right now, the stock market is not collapsing. And that's exactly what makes it dangerous. Major market declines rarely begin with a sudden crash. Instead, they start with a slow topping process. Prices move up and down, sometimes making new highs, sometimes dropping sharply. But overall, the market loses direction. This creates confusion. Investors don't know whether to be bullish or bearish. And during this phase, many people get trapped. They see a drop, then a recovery, and they think, okay, the market is strong again. But what they don't realize is that these recoveries are often temporary. They are driven by short-term news, not real strength. For example, one major headline can push markets down. Then another headline can remove that fear, and markets bounce again. But these moves are not based on fundamentals. They are emotional reactions. And this is exactly what we are seeing right now. The deeper issue is not the headlines. It is the structure that has been building for years. For more than a decade, markets have been supported by extremely easy money, low interest rates, high liquidity, and constant support from central banks have pushed asset prices higher. But this kind of growth is not natural. It creates imbalances. It encourages excessive risk-taking. And over time, it builds a bubble. Now, as that bubble starts to weaken, the system becomes fragile. And when the market finally breaks, something very important happens. Central banks step in. They lower interest rates, they print money, they try to stabilize the system. But in doing so, they also reduce the value of currency. And when the value of money goes down, the value of gold goes up. This is why gold performs so well during financial stress. It is not dependent on earnings, growth, or economic expansion. It is a store of value. And when confidence in the system declines, gold becomes more attractive. Historically, during past crises, money has flowed into both gold and government bonds. But this time, something is different. Bonds are no longer acting as a strong safe haven. Instead of rising, they have been weak in recent years. This means investors have fewer places to go for safety, and that makes gold and silver even more important. Now let's talk about timing. Even though the stock market is showing signs of weakness, it may not collapse immediately. In fact, we could see a temporary bounce. This bounce could be triggered by positive news. Maybe geopolitical tensions ease. Maybe economic data looks slightly better. And for a short time, everything feels stable again. But this kind of stability can be misleading, because once that temporary confidence returns, the real decline can begin. This is the moment when most investors are caught off guard. And as the market starts to fall more seriously, money begins to move, quickly and aggressively. That's when gold and silver enter their most powerful phase. As we look ahead, the big picture is becoming clearer. The stock market is likely in the final stages of a topping process. It may still move up and down in the short term. It may even rally briefly. But the underlying structure is weakening. At the same time, gold has already established strength. It has corrected, absorbed selling pressure, and held its long-term trend. This is exactly what strong markets do before their next move higher. Now imagine what happens when these two forces combine: a weakening stock market and a strengthening gold market. This is where capital starts to shift. Investors begin to lose confidence in traditional assets. They look for safety. And step by step, money begins flowing into gold and silver. At first it's slow, then it accelerates, and eventually it becomes obvious to everyone. That's when the biggest moves happen. The key takeaway is simple. We are not at the beginning anymore. The early signals have already played out, but we are also not at the end. We are likely entering the most important phase, where trends become stronger, faster, and more visible. If you want to stay ahead of these major shifts and truly understand what's happening in gold and silver, make sure to follow Gold Silver Scope. Here, we break down complex market movements into simple, clear insights so you can make better decisions and stay one step ahead. And remember, the biggest opportunities don't come when everything is obvious. They come when most people are still confused.